Okay. First of all, everyone, welcome for this IND AS and Audit series. As you would be aware that as part of our WIRC IND AS and Audit committee, we have decided for next 52 weeks, we'll take every Tuesday, 5 to 7 in the evening, sessions on practical issues and practical items with regard to IND AS and audit. This is the fourth session. Before we start, I would request to start the CA motto song, and then we will take.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तदेव शुक्रदब्रह्मा तदब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तनूनाथर्यकश्चनास्मि एतद्वैता 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 एतद्वैता.
So, thank you. I think so for the ones who have joined, again, just trying to repeat, the intention was to overall help all our fellow colleagues and people from industry to discuss on various IND AS related issues. So today we have a topic on key issues or key items with regard to IND AS, wherever from a financial statement perspective, issues has been identified. I would ask Pinky Madam to address and guide on the next steps.
Thank you, Chandan, and thank you, Salvi, and Viral, both the coordinator also. And at the outset, I want to thank C. Harsh Agarwal ji, our faculty of the session, that he accepted our invite to guide our participant for common error found with respect to IND AS. So it's a very essential subject, because many times we are in overconfidence that ये तो mistake हो ही नहीं सकती है, तो बहुत सारी चीजें हम overlook कर जाते हैं. So it's the best time to see the thing that what the error can be, we can get in our financial statement before signing our audit report. So we should take care about these things, and I think this should be happen every quarter, I can say, because in many time limited review also we require this thing. और जितनी बार याद करो आप भूल जाते हैं हम ये सब चीजें, छोटी छोटी चीजें, बहुत सारी चीजें होती है जो भूल जाते हैं. नॉट IND AS, बाकी कभी GST पर्सपेक्टिव से भी, टैक्स ऑडिट पर्सपेक्टिव से भी बहुत होता है ऐसा कि ये सब चीजें क्वार्टरली बेसिस पे वी हैव टू रिवाइज एंड अपडेट आवरसेल्फ, क्योंकि बहुत सारी चीजें आती भी है कि हमें कंप्लीट करनी होती है और हमें अपडेट होना होता है. सो इट्स अ बेस्ट टाइम that Harsh is agree to take this session, and this IND AS series is going very good, and I think everyone is appreciating this IND AS series. In our WRC site also you can find many session of IND AS in this time year. So all the best to all the participant, because I also want to hear Harsh ji with in this regard, because it's like a summarized of IND AS financial statement. If you can find the error, that is enough for to check the audit done by our subordinate or our junior. So Thank you, Harshji, again, and Chandanji also to coordinate the session. All the best. Happy learning. And one more thing I want to inform the participant to register for DTRC, our signature event of WIRC, which is going to be happen on 14th, 15th, 21st, and 22nd June at Yogi Sabhagrah. And our second signature event is regional conference, which is going to be held on 23rd and 24th August in Geo Convention Center. Also, both the registration are open for both the event. So please register yourself. And third program is for women only. It's the International Women RRC at Bhutan. It's from 6th to 14th July. So if you're, it's only for CA women, not non-CA females. So if your wives or your sister or any of the your family member is CA, they can join us at Bhutan. So please register themselves also. Thank you. Thank you. Over to Chandan.
Yeah, thank you, PG, for giving an overall guidance to everyone. I would request CA Salvi Sakaria ji to introduce our today's faculty. Over to you, Salvi.
Thank you so much. Hello everyone, this is Salvi Sakaria. Today I have got an opportunity to introduce our faculty, Mr. Harsh Agrawal. He is a fellow member of ICI and have an experience of decade and a half in the field of assurance and audit. He is working as a director at SRBC and Company at Pune. He has varied experience in handling audits under IND AS, IGAP, IFRS, and US GAAP. He has handled many IFRS and IND AS conversions in the past. He has a working experience of various listed and private companies, including some of the promoter-driven and multinational companies. So we would like to learn way too much from Mr. Agarwal today and gain knowledge from him.
Thanks. Thanks, Salvi. Before handing it over to Harsh and not discussing on various other topics, the next topic on next Tuesday is with regard to planning the audit. As everyone of are aware that we all are good at numbers. Auditing the numbers, we are very good, but in the current NAFRA world, documentation, FRRB, etc., documentation becomes very key. The next session is on planning the audit, what exactly you need to plan the audit, including the templates and documentation. So whoever have not registered, you can register for the next Tuesday session, and you can ask your fellow members if who want to gain benefit out of that can register. And before handing it over to Harsh, just I want to add what Salvi has added. So, and what she has not told about Harsh. So fortunately, we have someone who has like worked on more than 10, 20 IND AS financial statement of BSE 100 companies. So practically, he has seen more than 20 IND AS financial statement, and through his eyes, those financial statement has gone. So we are privileged enough to have him to deep dive on typical issues which might come, which we might not observe in an index. So thanks, Harsh, for accepting and coming and spending 2 hours with our participants. And over to you, Harsh. And next 110 minutes is yours.
Thank you, Chandan. Thank you, ma'am. Thank you, Pinky, ma'am. Thank you, Sandeep, for our introduction. And like you have already set the context, it's a very interesting topic, and it's my pleasure to have this session here. Thanks a lot for giving this opportunity. I have prepared a deck as well, which I'll put forth next few minutes. But I just wanted to put some expectations in terms of the session. Like again, thanks, Chandan, to again set a background. And this is the fourth session that I understand. So with the flow, it's good to have something like a common error which is there, because I was just thinking about the overall how the things are panning out of India. So if you see, I think 16 or 17, 2016, 17, India was first time introduced, and now it is almost 8 years, 8 long years that we have been seeing IND AS. Earlier, we were privy to some of the international standards which were pretty similar. That was IFRS and other gaps. But now the India INC is also stabilized in a way that many clarifications are there. We have many boards from the institute as well as other members, other professional bodies to have a lot of clarifications in terms of standards. So we have a lot of ITFGs, we have a lot of ESE opinions. So the standards are not new to us now. Right? After a good time, these standards are now not new, and obviously with that, now it is a time to fine tune, and also as an industry or as a faculty members, as members of the institutes, that it's our responsibility to ensure that the financial statements which are there at the public domain are error free in a way, because a lot of people depend on financial statements. There are a lot of decisions which are made by them. Users of financial statements have a lot of trust on us, and hence, as members of ICI and being professional, it's a duty to ensure that the financial statements which we sign, which we co-sign with the management, there's equal responsibility with the management as well. So attendees who are coming from the industry also, it's very critical for them to ensure that whatever financial statements you're preparing for your board of directors, for your chairman, etc., who are signing those off, it's very important to have as many as low errors in those financial statements. And in other words, the financial statement should be complied with the requirements of the law. It should be complied with the Schedule 3, which is there for IND AS, and also it should comply with the required auditing standards as well as the IND AS. So without wasting much time, maybe I will present the slide deck that I have. We have I have bifurcated it standard by standard, and the ask from you is that whatever questions you have, we have a Q&A chat box which is open. If you have any questions for the standard or outside the subject also, depending on if you have a particular question on any IND AS, I would be happy to take up at regular intervals. So let me share my screen. So some technical glitch on screen sharing. Maybe I need support here from Chandan. I'm getting a message.
Just
Host is
try-
disabling
there
the
is a-
part sharing.
Misra ji, please check.
There's
Misra ji,
green color
I'm
button.
here, madam. They are on way.
First, there is a
I
green
can do
color
it now. I
button.
can do it.
Yeah, just try to do the green color button.
Yeah, I
Yes.
can do it.
First, we could see that.
Screen is here. I'm just facing one more difficulty. Yeah. So we'll directly jump onto the topic. Yeah, thank you. So like I said, I have accumulated the session as per the IND AS, and we have roughly 13, 14 IND ASs to capture. These observations are coming from directly from the various bodies. So we have 3, 4 bodies, which is it can be NAFRA, who is reviewing the financial statements these days. So again, for the benefit of everyone, NFRA is a authority, National Financial Reporting Board. It's a government authority which is set up under the Companies Act. So that authority has full rights to review all the whatever publicly available information on a lot of listed clients and those clients which are covered under the NFRA. Then we also have the QRB, which is the Quality Review Board set up by the ICA, and also the FRRB board, which is the Financial Review Reporting Board. So these authorities, over the past few years, they have reviewed many financial statements which are publicly available. And the slide deck which I have presented now, or the items which we'll be seeing in the next one and a half hours, are those observations which are found on many financial statements. Obviously, we have not used names to protect confidentiality, but these errors, as we speak, have been conducted and have been signed by many top professional colleagues. And the idea is not to name anyone, but the idea is just to learn from these and ensure that whenever we are signing any financial statements, we do not repeat such mistakes and try to comply with the requirements of the standard. Moving on to the first standard, that is IND AS 2 on inventories. So this standard obviously talks about the valuation of inventories, and it also gives the various methods which are used for the purpose of valuation and also the cost formula. So typically, to summarize the standard in a minute, the standard talks about valuation of inventories which should be done on cost or NRV, whichever is less. And the standard also prescribes the costing formula. That is, it can be a FIFO, that is first in, first out method, or a weighted average method, or a specific identification. Generally, these are the first two methods are generally what we have seen in the industry overall. So this is the preliminary and very basic requirement of the standard. From a disclosure perspective, the standard expects disclosing various classes of inventory, such as raw materials, the work in progress, finished goods, stores and spares, loose tools, etc., packing material, on the balance sheet, and by way of a note to the balance sheet, to be more precise. So on the left hand side, you can see the error or the observation that in the accounting policy, the company has to disclose the determination of cost and components, and specific requirement of raw materials, WIP, FG, and store spares to be disclosed separately. So in one of the financials, the company has not disclosed the accounting policy. However, we also noted that the costing formula was not appropriately included in the accounting policy, and the company shall also disclose the basis of valuation. So this was not done. Incorrectly, the in that financial statement, the stores and spares were disclosed under raw materials, which was not correct. So that was an error which was made, which was not appropriate under the IND AS 2 category. Moving on to the next standard, we have the standard on cash flow statements, that is IND AS 7. Again, this standard requires an entity to prepare a cash flow statement using two methods, that is indirect and direct. These are the two methods prescribed by the standard. And if you have seen a cash flow statement, typically it starts with your profit and loss as per the P&L, and then you have to bifurcate the various cash flows from operating activities, financing activities, and investing activities before giving a reconciliation of the cash at the beginning and what is the actually cash generated from all the three activities, that is operating, financing, and investing. So it was observed that first of all, whenever there is a disclosure for proceeds or repayment of term loans, or proceeds or repayment or the inflow from fixed deposits, or investments, or redemption of mutual funds, or sale or purchase of property, plant, and equipment. So these items were shown on a net basis, which is not correct. So very specifically talking about the standard says that all these proceeds and repayment for loans, for example, should be shown separately. So there should be a line item for proceeds for that you have received from term loans, and there should be a separate line item for repayment of term loans. Many times people do a netting off, which is not correct. Netting off is allowed only in one situation where the standard says that it's impractical and the volume is so high. So we can assume a financial institute company where there are fixed deposits or mutual funds investments which are happening on a daily basis. So I've seen some companies where they invest every day, uh, or every 3 day cycle, 7 day cycle, just to ensure that they are not losing on the interest even for a day. So under the treasury management, if the volume is so high and it is absolutely impractical to disclose that, in such situations only net accounting or net disclosure in the cash flow statement is permissible from the standard. moving on to the next observation, we have the observation on the disclosure of changes in exchange rates on foreign currency on the cash and cash equivalents. So, friends, whenever there is a foreign currency balance, so typically if there is a EFC account or any bank account in a currency which is not your reporting currency, for example, if your reporting currency is INR, and if you have any accounting balance in a euro or a USD balance, so typically at every reporting period or every year end, you have to again do a revaluation of those accounts and ensure that you convert those balances to INR or in your reporting currency and disclose that in the financial statement under the cash and cash equivalents. While doing so, the effect of the foreign exchange gain or loss should be separately shown in the reconciliation of cash. This is a requirement, which is not done. Again, I have presented a table. This is the last bit of the cash flow statement, wherein you have the reconciliation of the cash and cash equivalent. So typically, this is the way how it should be shown. The net increase or decrease in cash and cash equivalent from the operating, financing, and investing activities, followed by the changes in the foreign currency balances. Compare that with the beginning cash to give your closing cash. This is the requirement. In very basic, people are using incorrect nomenclatures. So consolidated statement of cash flow, and the other one is consolidated statement of cash flows for the year. So these are typically two items which I have categorically bought in terms of just to know what is the correct disclosure. So anyone, maybe we have not used the chat box, or I have not heard from anyone in terms of what is the, are people having any doubts or anything? Can we have people who can want to participate? A or B, whichever is correct. Or anyone want to participate? So A1 is correct. Someone is talking about A, someone is talking about B. Any more answers? So we have equal tally now, A and B. Just like the election results going around today, tough competition. So we have both answers. Some more people for A. Yes, go ahead. Others, please participate. A, B. Any more answers? So it's like a MCQ which is on both sides. A is also looking appropriate, B is also looking appropriate. Very difficult to answer. Interesting. Wow. Maybe I'll wait for another 10 seconds. Others, A, B. Again, very difficult to find out which is the correct one. So I think there's an equal weightage to A as well as B here. Interesting. Yeah, statement of cash flows is the answer, right? So we'll see the result in then another 10, 20 seconds. Right, interesting. So coming to the answer, the B1 is the appropriate one because it talks about statement of cash flows, and that's the requirement, friends. You have to specifically disclose on the statement of cash flows when you are dealing with the cash flow statements. Like you have statement of profit and loss, like similarly your statement of cash flows. Very minute one, but important. Moving on to the next slide, next session. We have IND AS 19 to follow here with employee benefits. Let's see what is asked to say. So this standard specifically talks about post-employment benefits. It talks about the short-term employee benefits, current benefits, and the long-term benefits specifically. So as a requirement, there was an observation that the director sitting fees, which are paid to the directors, being classified under other expenses. So, what would be appropriate classification of such expenses? Are those employee benefit expenses or are those other expenses? So that's typically the question. Generally, the directors who are the whole-time directors are your people who are under your employee category. So the correct classification of this would be under employee benefit expenses and not under the other expenses category. The next observation was on the provisions towards gratuity liabilities and leave encashment liabilities. So generally, these are accounted and based on actuarial valuations under the PUCC method as per the standard. So measurement of such is done basis actuarial valuations. The disclosure of these liabilities, whether those are current or non-current provisions, should be made basis the actual valuation. So typically, the current liabilities are those which are expected to be paid or settled in basis your operating cycle. Or sometimes if the operating cycle is not appropriately defined, and many companies have adopted a 12-month period or a year's period as an operating cycle. So there should be appropriate classification of what is gratuity for current and what is non-current gratuity typically. So this was not disclosed, and hence the observation that it was completely classified as other current liabilities instead of bifurcating it into current and non-current liabilities. Do we have any questions? I can see some chat box. I'll just try to see. Yeah, I can see some questions here. I'll try to answer them. For the benefit of everyone, I'll just read out. Is it mandatory to carry out actuarial valuation as per IND AS 90? And the other question is, what if a company has only one employee? Interesting. And there's one more question on the earlier slide. We'll try to cover that later. We'll try to cover the cash flow, the employee benefit first. So to answer your question on the employee benefits right away, the actuarial valuation is required because the moment you have employees, you have post-retirement benefits. So it is very difficult for anyone to calculate the precision of what should be the liability amount that should be recorded on day one. So typically, actuary will see your company profile. They will have a lot of assumptions in terms of. So typically, if you are having say 100 employees at a particular age, so they have assumptions to see at what age, what is the policy for the company to have the retirement age, what is the exit ratio in terms of how many people will leave before completing the tenure or they will switch, how many new people will join, what is the current salary levels of those people after considering inflation, what should be the payout and the age of their retirement. And there are various other parameters also, which we typically call as actuarial assumptions. Two, three best category actuarial assumptions are what should be the discount rate that should be used to discount the future liability at the present date, what should be the salary increase rate which should be considered. So these are typically calculations which are beyond your Excel and beyond your as chartered accountants. So it's very difficult for us to make those assumptions and calculate. From an industry side also, it's very difficult for the management to exercise or find out anything. And hence the standard mandates that you have to perform actual valuations and calculate the liability, which should be accounted immediately at every reporting period. And even if there is one employee, then again, depending on materiality and depending on what should be the quantum of your employee benefit, long-term employee benefit obligations, the book answer is yes, you should have an actual valuation. But if the company is having some method to calculate any provision which is mandatory to be classified as a long-term employee benefit provision, that would be required to be made. I hope I have given the right answer to the question. On limited reviews, it may or may not be required because a limited review, again, it's a materiality call that we take. So in one of the companies where the actual employee base was large, we had asked the company to do a 6 monthly. So every quarter, uh, they were not doing it. They were doing it every 6 months. That is alternate quarters. And every quarter they had a catch up. So for example, their liability increased from 100 rupees to 110 rupees over a year. So the assumption was there is a 2.5 rupee increase every quarter. So without doing an actual valuation, the company used to then take up top up provision. And obviously every 6 months they used to actualize this. But this is not written anywhere. This is obviously judgment exercise by the management and us. But obviously at the time of limited reviews, you have to take care of and ensure that from an industry perspective, there are not many changes. So for example, if you are the answer will change if there are changes in situations. So take an example, if the company have sold off one of the units or and 50% of the employees are retrenched, for example. In that case, there will be a requirement because otherwise, if you carry forward the same year-end balance and there is a significant change in your workforce or if there is a significant change in the atmosphere outside in the environment, then you will have to go for actual evaluation. Again, that will depend on what are the expectations in terms of changes. Next question is actual evaluation mandatory? Yes, it's mandatory. Current, non-current, you're saying, can we rely on the actuary? Yes, so I'll come to that. So again, giving a background, the actuary will typically calculate. There are two things. So actuary will have a short-term employee benefit expense, and the actuary will also have a total calculation for what is the expected payout in 1 year. So the actuary will typically use the assumptions in terms of what are the trends, what is the company policy, what is expected payout for the gratuity amount in 1 year, and then typically he'll make a classification of current versus non-current. So it is a safe bet because here you are relying on the expert. So it would be a safe bet to rely on your actuary if he is a reputed member of the Institute of Actuaries of India. And in this case, we are typically using the auditing standard, relying on the work on experts. So here, as an auditor or as a professional, CA professional, your duty is to ensure that the right person is doing actual evaluation. And you have to check the competence and reliability and independence of the actuary. And if you are satisfied with everything, then you can rely on. Wow, good questions. Do we have anything else on employee benefits? Otherwise, without going ahead, maybe I will take some other questions which are there in the Q&A pertaining to earlier ones. So a couple of questions in the Q&A. By the time others are requested to post their questions if they have. One question comes about director's fees paid to independent director will classify under employee benefit. Answer may be no. Independent director is not an employee. So those example was only for the employee directors. Independent director fees will be classified as professional fees. Or if it's a significant amount, you can classify that as a separate item other expenses. We have another one on the foreign exchanges few slides back. So the question is in change in change in foreign exchange, do we have to consider trade receivable and payable outstanding for cash flow statement? The answer is yes. You have to consider the unvalued. So there would be two types of foreign exchange differences. One is a realized difference, one is an unrealized difference. So unrealized difference is a cash item. It's not a non-cash item. Only the unrealized foreign exchange difference is the item which should reflect in your cash flows, but it should not be reflected in the place where I showed in the PPT. It will go under your operating cash flows. Your company is dealing into any activities, and if they have receivables and payables in foreign currencies, the closing restatement, the effect of closing restatement will go to the changes in operating cash flows. I could see one question on impact of IND AS on cash flow. I did not understand the question. I would request more clarity on this question. So there is a question in the Q&A which talks about impact of IND AS on cash flow. If I assume impact of IND AS on cash flow, if you want to say that if these provisions are non-cash, should this be adjusted? The answer is yes. This will come in the moment of your provisions. So typically, if you see your cash flow statement, you start with PBT, that's profit before tax, followed by your non-cash items, which can be depreciation, effect of foreign exchange differences, impairment allowances. Then you have finance cost, finance income, because those are reclassifications from your to investing or the financing activities. And then you have to mention the effects of working capital changes or changes in your assets and liabilities. So typically here the impact of your closing provisions will be there. So if you have some other question for this typical one, I hope I have answered. If you have any different question, then you can repost. Assuming all questions are answered, should I move ahead? I hope I have answered all questions so far. Okay, there are new questions in the chat box also. Let me go through that. So I have one question on cash flow, which talks about cash flow related query. If a fixed deposit is kept as a security against loan, whether the interest should be financing activity or investing activity. Very good. You have a fixed deposit and that's kept as a security. So first of all, I'll answer your question from a classification perspective. These deposits should not be classified as cash and cash equivalents. These deposits will be classified as other financial live assets under the asset side, with a specific disclosure on the securities, and the interest will be under the financing activities specifically. Perfect. Maybe we move ahead to the next standard then. I hope I have answered all your questions. The next standard is on related party transactions in IND AS 24, and let's see what the standard has to say and what are the common pitfalls of this standard. So typically, this is a disclosure standard. The standard requires that all the transactions with your related parties and key managerial persons should be disclosed appropriately in the financial statements. So the query or the observation was the amounts paid to the key MPs, the key managerial persons, should be disclosed in the following categories, which is short-term employee benefits, post-employee benefits, other long-term employee benefits, termination benefits, if any, share-based payments, etc. And typically, if you see the table below, this is what is the actual disclosure given by one of the companies, where it talks about, if you see the left-hand side, discloses the salary, pension, reimbursements, etc. given to various people, ABCD, and on the right-hand side, on the top of the table, this disclosure is for KMPs, relatives of KMPs, subsidiary companies, etc. So basically, they have not bifurcated KMP-wise what is a short-term payment, what is a post-employment benefit, and what is a long-term benefit, which is a specific requirement of the standard. So this observation came up that appropriate disclosure has not been given. They have only mentioned the total amounts. If you see, this could be in a better classification and a disclosure. If you see the next table, which is just put up now, it shows, so typically you can give ABCD columnar as in various KMPs and bifurcate the payments into short-term payments, post-employee benefits, long-term payments, perquisites, total values, and also very important, the outstanding amounts, if any, should also be disclosed. Yeah. And the next one in the IND AS 24 category was there was some doubtful debts created on trade receivable balances, which were receivable from related parties. and this disclosure was not made, or this was not disclosed under the RPT transactions. So typically, first question arises on the intent in terms of if there is a related party, how can there be a bad debt or doubtful debt? However, in rare situations, if there are provisions for doubtful debts on related party transactions, those should be appropriately disclosed and given in the financial statements. I will again pause for a minute. We'll just see if there are any new questions that have come up, because I think it would be better to have the question answered right away, immediately during the specific topic. So I do not see anything in the chat box. I cannot see any new question in the Q&A box as well. Maybe I'll pause for another 10 seconds for people to ask questions if they have any. So assuming no questions on this topic, moving on to the next standard, which talks about earnings per share. So Ind AS 33 deals with the EPS standard, and summarizing this, the requirements of the standard requires to disclose what is the earning per share, and so earning per share typically is it's a per share value by which is calculated by getting your what is the net profit attributable to the equity holders, and you divide that with the weighted average number of equity shares. Similarly, if there are any other instruments, then there is a requirement to give a reconciliation of the earnings as well as the requirement of the what is the weighted average number of equity shares. Again, if there are dilutions, if there are anti-dilutive instruments, then the standard requires to have a working for that also and give the effect of dilution and have a disclosure for basic EPS and a dilutive EPS. That's broadly the requirement of the standard. Let's see what are the common errors. Yeah. So it was noted that there was a note given to the financial statement that company has to disclose a reconciliation, like I said, of the weighted average number of equity shares used as denominator in calculating basic and dilutive EPS. This is the way it was given. What was the weighted average number for EPS, effect of dilution, and weighted average number of equity shares after effect of dilution. So it was observed that company has disclosed EPS in the notes. However, it was noted that company failed to disclose the weighted average number of equity shares to calculate the exact balances. Some error. It was also noted that as per the requirement of the standard, the incorrect terminology was used. The terminology that was used was profit or loss attributable to ordinary holders. However, the correct terminology is to state the numerator for calculating dilutive earnings per share. Also, very important, the accounting policy was not disclosed in terms of how the dilutive earnings per shares are calculated. So, very important to give an accounting policy also to if there are dilutive shares. So, how is those calculated and what is the policy for that? It should also be given in your financial statements. I think I have new questions. I could see a RPT question, and I could also see a few more questions in the chat box. These are all pertaining to the earlier slide. So maybe I go back when I'm answering this. So there's a question which talks about, does the KMP of subsidiary associate become related party of the group just because he is a KMP of associate subsidiary? Okay. So again, specifically going to the standard, there is a definition of the key managerial person. Key managerial persons are the directors of the company, relative of such directors. So just because the KMP of a subsidiary associate, it becomes related to the group, is a KMP of the subsidiary or associate? Not necessary. The answer can be yes or no depending on the situation. To answer your question, so for example, if you have a common director under both the companies, and there is a common relative, then the relative of that KMP will become a KMP if it falls within the definition of KMP, right? The next question is on unbilled revenue, receivables book to comply with transfer pricing pertaining to parent company should be disclosed under related parties or not. Yes, unbilled revenue which is not billed, however, that would be billed in future course or the next month should also be disclosed under the related party transactions as receivable from your related parties. The next question is on so can you educate us on disclosure of related party transactions involving no considerations? Okay. I can try to give some general idea of if there are any related party transactions without any consideration. So first of all, to start a very basic conversation on related parties, the requirement of the law and the requirement of the standard is that any related party transaction should be at arm's length first. There's a specific section 177, 188 of the Companies Act, which specifically says that all your transactions with related parties should be under the, if those are under the ordinary course of business, and if those are at arm's length, if you can prove that, then there is no specific requirement to take any approval. If your transactions are not at arm's length, or if your transaction is not within the ordinary course of business, then you have to take various approvals. And there is a series of approvals. There are limits also. I will not go to those granular details. But generally, you have to take a board approval. First, you have to take an audit committee approval if there is an audit committee to a company. And also you have to take a special resolution, that is a shareholder approval. So sorry, some situations. So if you have a case of any related party transaction with no consideration or zero consideration, so first of all, it should be approved by everyone. It should be approved by the board, it should be approved by the audit committee, it should be approved by the shareholders. Second, IND AS specifically covers the situation. So to take an example, if your parent is giving something without any consideration to your subsidiary, so there is some accounting which gets triggered. So if it's a financial instrument under IND AS 9 or IND AS 107, so the requirement, and I'll take an example. So for example, if you have a loan from a parent company without any interest, so you have to see what is the equity component of that loan. So that loan typically will have to be bifurcated between an equity and a liability. The component of interest which your parent is not charging, that will have to be identified as an equity contribution from a parent, and that will go to your retained earnings, and that loan will be accounted at a discounted value, to take an example. And obviously, whenever you accrue your interest, your financial statements, then that on the payable date, that loan will again be restated to its original value after you give the effect of interest every year. So I hope I have answered this question. Next question was on definition of RPT under various laws such as Income Tax Companies Act. That's a long question. So it talks about definition of RPT under various laws such as Income Tax Company Act, SEBI, which RPT should be covered under the annual report. So all RPTs, so to answer your specific question, if we have a related party which is coming only as per the SEBI regulations, so that should also be covered. So everything should be covered in short. So a comprehensive list of RPTs should be maintained by the company under various acts. Obviously, income tax is not a different act. Income tax will generally cover everything. So I will cut my discussion to Companies Act, IND AS, and SEBI. Income tax generally will follow these three. So the stricter of all three will follow. And specific example, if there is a party which is only coming as a related party under the SEBI LODR and not coming as a Companies Act related party, everything should be covered. That's nice. I have a question which will also allow CCD maturity of 10 years. I am not able to understand this question. Whoever has answered has requested for a question. I request more clarity. So there is a question here. Will it also include CCD maturity of 10 years? I am not able to get what is the exact question here. Uh, it's a follow-up question for diluted EPS. Will it also include CCD having a maturity of 10 years? So I think this question now I can relate. It's pertaining. I think it's pertaining to the EPS standard. And your specific question is if you have a CCD, that is a complete compulsory convertible debenture, and having a maturity of 10 years, will it have a diluted EPS? The answer is yes. If you have an instrument which will be compulsorily converted, then you will have to see the effect of dilution, if any. Again, I think questions covered. If I've skipped something, you can repost. And I think I can move on to the next slide. The next is on IND AS 37, which talks about provisions, contingent liabilities, and contingent assets. So let's see what is the requirement of the standard. The requirement of the standard is about disclosing various type of provisions. Along with the movement of such provisions, the standard also talks about what is the nature of the provision, what is the uncertainty about it, what is the expected outflow arising out of these provisions, because provision by itself and contingent liabilities for its by itself, by its nature, are those which are not certain, and there is some estimate or assumption made by the management while they determine these values. So the standard is very clear that whatever you are doing, you have to give a disclosure, make the users aware of what is the provision, how does it look like, what is the nature, what are the uncertainties involved, etc., etc. So it was observed that these all things were not given by the company. So to take an example, typically warranty provision is a classic case. Many companies, product companies will have these. So first of all, you have to explain the nature of the provision. For example, if it's warranty, you can have a small paragraph note which says that why is the company required to give warranty. You can say that company generally gives a warranty of say 3 to 6 months, or maybe 2 years to 3 years, depending on the product. You can also mention that the liability of a warranty is accounted using, say, past trends. You can also mention that the outflow is uncertain. You can also mention that depending on the past trends, whether the liability is a current liability or a current provision or a non-current provision, that can, all these parameters can be disclosed by way of footnote. Obviously, needless to say, you have to also give a movement of what is the beginning balance, what are the additions, reversals, utilization of the provision, and the closing values. So in some of the financial statements, this was not given as observation. I will see if there are any questions and request others to have post their questions if they have any. So there's one question: what other extra sources to verify contingent liability or contingent assets? Okay, very good. So typically, contingent liabilities are those which are uncertain. So maybe we divide the liabilities into various parts. So contingent liabilities can be arising out of uncertain tax positions. So your company may have a series of cases going on around them. So first source is to check with your management, check with the legal team. Are they maintaining such logs or such case histories? The other direct source is to go to the website of the income tax department, GST department. These days, whenever you put your PAN number or other registration numbers, get a series of open cases against them. So this is the external source. As auditors, we can go check your company if they're having any outstanding cases to see if there are any contingent liabilities. And also you can see the summary assessments. So for example, you can check with your client. If the assessment is clean, then generally will not have a liability for that year, right? Or if there are any other audits, department audits, GST audits, etc., which have been taken place during the year, or then you can check with the legal team, the tax team, if there are any other contingent liabilities. The other category of contingent liabilities is non-tax cases. So you can have any civil cases against your company, you can have any other rights, you can see the bank confirmations to see if they have given any guarantees, right? So typically these are the sources where you can see what are the, if your contingent liability disclosure or counting is complete or from contingent asset perspective, again, you can check with your management. You can check with are there any cases or are there any situations where the company may gain which they have not yet accounted for? Any cases where your company has made a claim against some other company and where there's an expected inflow. So those are the sources where you can get your contingent assets. Custom and other contracts, I think either there's a ICE Gate portal where you get, or there's a GST portal again where you get your cases. There's also a question of other contracts. So here, my friend, you will have to see your purchase contracts, if there are any onerous contracts or not. Typically, there are indicators when you are auditing. If you have indicator that the company is selling at a loss or the NRV is low, or if there are some contracts which are having onerous contracts in nature, there's a cost overrun going on, for example. So you have to sense these uh, questions in the course of your audit and see evaluate contracts to see if there are any onerous contracts or. I hope I have answered any other questions. Happy to take that. Let me see the Q&A. Q&A doesn't have anything new. Chat, whatever was there, I have answered. Again, I'll pause for some time. If you have any questions, please post. So maybe we move on to the next standard, that is IND AS 38 on intangible assets. So this standard talks about your recognition, measurement, and disclosure for intangible assets. Now, intangible assets are those which are typically other than your tangible assets, such as software licenses, trademarks, customer contracts. Goodwill is a classic example of an intangible asset. So there are multiple errors, this example which I have taken up. So under this, if you can see the table, under the property, plant and equipment, the company has disclosed value of goodwill and they have given a moment of gross block, depreciation, net block. So going back to the standard, and this is a combination of standard 38, this is a combination of standard 103, which talks about business combinations, where the goodwill would have been arised. So, and also goodwill, it was noted that goodwill was more than 50% of the assets of the company. So again, a critical item, very significant one, and this is the way how they had disclosed it, which was not correct. So what could have been a proper way to disclose this? We can use the chat box to give answers. What's wrong here? Before I ask a direct question, what's the error that they have made here? Anyone? Absolutely right. Classification is wrong. They should be shown on the face of the balance sheet. Bang on, perfect. So first error that couple of people could pick up was this is not shown as a separate item on the balance sheet face. Absolutely correct. What else? What is another error? Right, goodwill should be shown on the face of the balance sheet. Disclosures are inadequate. Amortization in case of goodwill, again, that's a problem, correct? So two errors so far. So three errors so far. Classification is wrong. It's not a PP&E. Second, it should be shown separately. Third, disclosures are not correct. Fourth, amortization in case of goodwill is wrong. Someone is saying that impairment, if any, should be given. Right, absolutely right. You're almost there. Separate note should be given for PP&E and intangibles. Perfect. Formatting should be vertical. Okay, for the timing, we ignore formatting. Let's see if at least the required items or the requirements are fulfilled. Then again, someone is saying goodwill is not allowed to be amortized. Perfect. I think we have the answers. Thanks everyone for your participation. And so almost we have catched what are the errors. So let's see. So absolutely right. First of all, goodwill is not a PP&E. It's a separate item. Goodwill is a separate intangible asset. It should be shown separately on the face of the balance sheet. Second, accounting policy for goodwill and impairment should be given. It is not an item which is to be depreciated or amortized. It should be mentioned on that annual impairment test has been done on goodwill. Necessary disclosures should be given. No disclosures was given. Right? I think we are almost there. Everyone was able to pick this. And we have one more example. The next example is for amortization. So this is a classic case, multiple errors here. So I'll read out for the benefit of everyone. The accounting policy or the notes to the financial statement stated that goodwill and trademarks are amortized over the estimated useful life of 20 years as allowed under the approved scheme. Further, keeping in mind scheme accounting for the excess of fair value of equity share issued and cancellation of investment in transferee company, fair value of net assets of transferee company amounting to so and so acquired as goodwill representing intangible assets. Wow. So basically, it's violating here. It's stated that it's amortized over 20 years, which is not allowed. So if there is any scheme and it specifically states that goodwill should be amortized, that's not appropriate, that amortization, etc., will follow for tax purposes, if any, not another act. It has to be tested for impairment. So this is it. It was not shown correctly. All right. Again, big thanks for participating. Maybe we move on to the question and answers a bit. If you have any questions, you can post. It was more of an interaction in terms of what is correct, not correct. Any questions that anyone like to answer, ask in this area? Okay, there is a question on how disclosure or changes in first time adoption under IND AS versus subsequent financial years. Okay, we have a session on 101, some slides. I will try to cover that. Any other questions on this standard on intangible assets? Think no. I will take up one more slide on the standard. Again, intangible assets under development was disclosed under PP&E. which is not appropriate, it should be separately disclosed below non-current assets. So if you see the table, the second table, that's a more appropriate and a correct classification of the intangibles under development. So people have a tendency to club everything. Earlier, they used to have tangible and intangible assets under one table. So it should be separately disclosed on the face of the balance sheet. It's a requirement of Schedule 3. Before I move on to the next topic, any questions? Or any more questions? I'll pause here for people to write if they have any questions for the standard. I don't see any further questions coming up. So without waiting, I think we can move on to the next one, which talks about IND AS 40, that is investment property. So this is a very interesting standard, and I can see one question. Let's see if it's related to anything. So I have one question. I'll again go back before I start the new standard. So it talks about, do we need to disclose intangible assets under development as a separate line item, or can be clubbed with intangible assets? The answer is you have to show it separately. There is a specific requirement under the Schedule 3 of Companies Act, and it is a separate line item. In fact, one step ahead, you also have to give a aging of the items, the intangible assets under development, and also disclose if there are any items in this category which are overdue, okay, which are overdue from the date of completion. Project-wise status needs to be given under the revised Schedule 3 requirement. Okay, assuming no further questions, let's go on to the new standard 40. So investment property is a standard which specifically talks about requirements and disclosures and measurement for investment property. Now, what is an investment property? Investment property is any class of asset which is typically a fixed asset, which is held by the company either for the purpose of capital appreciation or for earning rentals or similar sort of investments. So a typical case can be an office building, which was earlier classified as a property, plant and equipment. But if you are not using that property, plant and equipment or that building specifically for a requirement of your business, you are holding that property for either gaining rental income or either having a capital appreciation, then that asset should be classified as an investment property. That's a bare requirement. And the standard also talks about depreciation should be charged on this asset. So the observation was, in the accounting policy, it was stated that depreciation on investment properties was not charged in the reporting year. But the depreciation of such investment property was charged during the comparative year. So I don't know why they made this disclosure, which was absolutely wrong. So as a requirement, every year, like you have to charge a depreciation on your property, plant and equipment. Likewise, depreciation on investment properties also should be charged. If that asset is not non-depreciable asset, for example, if you're holding land, it is not depreciable, then that's a different case. Otherwise, depreciation should be appropriately charged for the requirement. So the policy itself was wrong. They did not charge depreciation. So that was the error. The next one was they had stated that investment property is measured at cost less impairment, if any, and any gain or loss on is calculated as the difference between net proceeds is recognized in the P&L. Subsequent to initial measurement, investment property is measured at cost less accumulated depreciation, impairment, and depreciation is calculated using the SLM. So this was the accounting policy that they had given. Anyone who can give me the answer to what is missing here? So this is right. This is not wrong that they have done, but something is missing here. What they have missed? Answers on the chat box, please. If you have, I'll just put up this again. What is missing here? And I'll pause for another 10-20 seconds for people to accumulate their views. What is missing? Fair value disclosure is missing. Life of the asset is missing. Any more answers? Residual value is missing. Age of the asset is missing. That's right. Life, age. Any more answers? We have got the answers. So you're right. Age, depreciation, life, policy, or age that was missing. The rate at which depreciation was charged was not mentioned by them, and also requirements or other requirements, which are the disclosures, the other requirements of the standard, what is the fair value, etc. That is as per paragraph 79B of IND AS 40 was not made by them. So far, so good. Any questions on this standard before we move on? So I'll pause for questions to come in. We already have a question here. Okay, the question is land and building held for business of leasing and a part of building is sold at a profit. So first of all, if your leasing is not your principal activity, and if you are holding a land and building for the purpose of leasing, okay, the purpose of leasing means earning rentals. So the correct classification of this land and building is not PP&E, it is investment property to start. Okay. So if you're in the business, if you're not in the business of leasing, and if you have land and building which you're categorically held for leasing purposes, and a part of that building is sold, then the classification would be investment property to be specific. The next question is on revaluation. How upward or downward revaluation of investment property has to be reported when all the assets under same head of assets have been revalued? For example, whole building has been revalued. So again, as a background, either you have to follow a revaluation model or a historical cost model to start with. If you are following a historical cost model, then as per IND AS 40, only a fair value disclosure Okay. Only the fair value disclosure of that investment property needs to be given first. Second, if you are following a revaluation model, then the requirement of the standard is that you have to revalue all the class of assets under the same category. So if you have 10 buildings under the investment property category, then you have to revalue all of them. You cannot pick and choose. And if you do so, then you have to disclose the upward revaluation or downward revaluation as the case may be in the financial statements. Okay. I hope I have answered the question. Do you have any more questions coming up? Maybe again, half a minute pause here before I move. So I think we move on to the next question now, next topic, that is common errors under IND AS 101. So IND AS 101 is a standard where in any company who is migrating from their earlier gap, that is India gap to IND AS. So they have to mandatorily see this standard, that is IND AS 101. This standard typically talks about few requirements, which are some are mandatory, some are optional, which gives some relaxations to the people following the IND AS. So there are typically few mandatory changes which are required to be done, and few are recommendatory or few are not mandatory, I would say. And while doing so, whenever you first adopt, there is a requirement that you give a reconciliation of your gap differences. So again, as a background, whenever you're doing a conversion that is not to be done for the first year, then to prepare 3 balance sheets. So to take an example of the current year, if you are preparing the first time IND AS of your company as at 31st March 2024, then you have to make a IND AS balance sheet as at 31st March 2023, which is the opening year, which is the comparative year. And you also have to make a IND AS balance sheet as of 1st April 2022. That is the opening balance sheet for prior year. So in a way, in nutshell, you have to prepare 3 balance sheets. And there is a requirement that you give a reconciliation because last 2 years have already been reported. For those 2 years, you have to give a reconciliation. What was your profit? What was your equity? And what were your differences in your balance sheet amounts reported under your previous gap? And what is the IND AS number, and a reconciliation to that, followed by notes to explain those changes, why those have been done. So the observation was that the adjustment was not given for all items reported in the balance sheet, which was contravening the requirement of paragraph 25 of MANOVA. So typically you have to just carve out your balance sheet. What was your earlier balance sheet and what is your new balance sheet? And whatever changes are there, you have to then, so for example, earlier on the balance sheet side, there were other assets. Now you have to bifurcate your assets between financial assets and non-financial assets, as per the requirement of IND AS 107 and 109. So that reconciliation should be given by way of a specific note to your IND AS financial statements. So that was not given by this company, which is not correct. The second observation on 101 was that financial statements of the company had the explanatory notes for reconciliation of previous gap to the new gap by way of giving a disclosing note for gain on fair value measurement. However, it was noted that although explanatory note was given for a reconciliation of previous gap, there was no, the note was silent in terms of how the transition from previous gap to IND AS affected the reported balance sheet, the financial performance and cash flows for that entity. So other than this reconciliation, you also have to mention a note about how have the transaction affected your balance sheet position. Are there any changes in your cash flows or any financial performance of the company has been different if you have followed IND AS for the first time. So this was not given by them. Again, observation. The next observation was on the, again, value of investments and measurement of investments have not been disclosed. So typically a requirement that whenever you are fair valuing, so the investments in, so take an example of mutual fund investments or any current investments which are valued at fair value through profit and loss. So these FETPL instruments were restated, and the carrying amount of such investments was at fair value now. However, in the note, as disclosed in the note to reconciliation of equity and P&L, as previously reported under the Indian GAAP, no effect was given on account of the transition. So thus it was viewed that the carrying value of investment is same, then a note should have been given. So maybe while doing India GAAP also, they would have revalued this to market. And while doing so, the reported numbers in the prior GAAP and the newer GAAP was same. I don't know how, but if that was same, then they should have given a note to explain this, which they did not. Okay, before we move on to the standard, let's see if we have any questions or one-on-one. And I remember one question. I will take up that. So I remember there was one question on 101. I request the participant to repost it. I think I couldn't see it right away. What was that question? I remember there was one question on 101 some time back, and I had said that I will take it up. So there is a question on where to report changes on account of moving from division 1 to division 2. Is that a reconciliation item in the financial statement? So there is no requirement to give a reconciliation when you change from your disclosure of Schedule 3 from Division 1 to Division 2. The requirement under the IND AS 101 is to give measurement and disclosure changes arising from gap adjustments. But there is no requirement to give any reconciliation as such when you are changing the Schedule 3 requirement from Division 1 to Division. There is no requirement. Do we have any further questions on 101? Yeah, there was this question on subsequent. Yeah, so please cover how to disclose, how the disclosure will change for 101 in the subsequent years. So in the subsequent years, your financial statements are already under IND AS, right? So there is no requirement to disclose your first time adoption note. That will go away. So there is no requirement to give any specific disclosure under 101 for the second year under IND AS. The second year under IND AS will have to be complied with IND AS, giving all disclosures, fair value hierarchy, financial instruments, etc. There is no specific requirement to have a 101 note from second year onwards. All right. Do we have anything else in 101 before we move ahead? I don't think we have any further question. Moving on to the next standard, that is business combinations. Again, a very interesting and a bit complicated topic, business combinations. So this standard talks about whenever there is an acquisition of a new company, and I'm just giving a background before going on to the question or the error. So this standard specifically talks about mergers, acquisitions, or any reverse mergers, split offs, or any changes in control when you are accounting your subsidiary and parent relationship. So very basic, the standard says that if you are accounting for business combinations, then you have to follow a particular method of accounting when you are making your consolidated financial statements, then you have to use a pooling of interest method, which is prescribed by the standard. And what is this method? This method, when you're doing line by line consolidation, then you have to, and to take an example, if you have acquired a new entity, then you have to assess whether this is a business combination or not, or an asset purchase. If it is a business combination, the standard says that you have to do a activity of fair valuing your assets and liabilities which you have acquired. So you have to compare the fair value of your assets and liabilities acquired with the consideration that you have paid. If your consideration is higher than the fair value of assets and liabilities, then you have paid some goodwill to acquire that business. Okay. And if it's a reverse situation, then there's a bargain purchase. This is typically, nutshell what the standard talks about. The standard also talks about there are many transactions which are under the common control. So what are common control transactions? Common control transactions are those which are within the same management. So assuming a group of companies, say A, B, C, D, and say company Z is the parent company. So this entire group and transaction within those groups are common control transactions. Specifically, the standard says that if there are common control transactions, then this fair valuation activity need not be done. Okay, because you cannot earn out of yourself. So you cannot. So if the book values are say 10 rupees of assets and 5 rupees for liabilities, then you cannot earn between yourself. You cannot transfer those assets at say 100 rupees. You have to do the book value is assumed to be fair value under common control. This is a common understanding of the standard. Now let's see what error they made. So this is the note that they gave. They said that the relevant abstract is as follows. So business combinations arising from transfer of interest in entities that are under common control are accounted at historical cost. Okay. So it cannot be accounted at historical cost. This is not correct. And the difference between any consideration given received on carrying amount of assets and liabilities of the interest acquired or disposed are recorded in retained earnings. Okay. So this was absolutely mixture of many things which they did. It was not appropriate. So the correct disclosure would have been should be accounted using the pooling of interest method. And again, historical cost accounting is not allowed. Okay. And necessary disclosures again were not made by them. So again, an error. I could see some questions on this. Let's see. Let's see if there are any questions on 103 before there are some follow-up questions. We'll pause here for questions on 103. Let's see. Any questions? So I could see a question on 101 and I'll read out for the benefit of everyone. So this question is on, is there any requirement for any disclosures for subsequent FS? In the subsequent FS for the relaxations available in 101 in the previous years. So there is no requirement. Obviously, however, if you want to be prudent, generally I have seen disclosures under the fixed assets or the PP&E. So there is a exemption relaxation available in the IND AS 101 for PP&E values that your carrying values of earlier gap can be carried forward as fair values or book values under the IND AS. So that if you have assumed to be taken the book values of earlier PP&E values, that note can be given, but it's not mandatory again. But just for clarification, you can give those. And the second question is, what are reporting requirements when there is a different date for transaction and status? Like earlier, the investee entity was an associate company. I honestly did not understand this question. I would request to repost what is the exact question here so that I can take it up. I have some more questions. So this question is again on 103. The question is on, in case of bargain purchase, what are the disclosures? Also, is there a capital reserve under IND AS? So to answer your question, there is no capital reserve as such. Uh, Anything which is, if you are falling in this bracket of having a bargain purchase, then that will go through the retained earnings only. It is not going through a capital reserve. Capital reserve was an earlier concept. There is no such concept in the IND AS. This is one question on 103 under IND AS 103, how reporting will change when entity has acquired shares at a different date. Okay. So there is a concept of step-up acquisition under 103. So you have to see at what date. So if you are, so the question, if I would like to decode the question, so the question is that you are acquiring shares at a different date. Okay. So for example, there are total 100 shares, you acquire 10 shares now, 10, 20 shares later on. So here, this is a step-up acquisition typically, and this case is envisaged by the standard itself. So here it's very important for you to determine at what date you gain control of that subsidiary or that company or that associate company. So for example, you are acquiring 10 shares. You have to ensure that and you have to calculate at what date you are gaining control. And from that date onwards, you have to count for that under 103. The next question is on how bargain purchase is shown in cash flow statement. So the cash flow statement typically will ask you to have disclosures for what cash you are acquiring from the business that you have purchased, and there's a requirement of the net cash outflow on account of business combinations. So if it's a bargain purchase or a goodwill, irrespective, you have to only in the cash flow statement, you have to give what cash outflow happened on account of this business combination or this acquisition. And there is a specific requirement that if there is any cash which is acquired in your business combination, then that cash amount should be separately disclosed. These are the only two requirements under the cash flow statements. There's no. So even if it's a bargain purchase or whatever, it has to be given a complete disclosure of what is the total amount of outflow on account of the combination. Do we have any further questions? 103. Moving on to the next standards, couple of them, IND AS 20, government grants, and 107, financial instruments. Let's see what errors they have. So this one is for the grant. So in case of depreciable assets, the cost of the asset is shown at a gross value, and the grant is taken to capital reserve, and which is recognized as income in the statement of profit and loss or the useful of the asset. So this accounting treatment itself is wrong because para 14 of IND AS 12 talks about government grants relating to depreciable assets. And the two treatments which are allowed, it can be treated as a deferred income, which should be recognized in the P&L or on a systematic basis, or it should be shown at a net value when the grant was received. So assuming they followed a gross accounting, then this capital reserve should not be shown. This should have been treated as a deferred income, which is again a liability in your balance sheet. And that liability will go on reducing when you recognize this as an income in your P&L statement over the life of the asset. So this was the error that they made. The next one is on financial instruments disclosures, and there's a requirement to disclose if you have investments, then those investments should be bifurcate into quoted or unquoted investments, and the market value of such investment should also be disclosed. So in the given disclosure, this was not given. If you can see this note, which was there in the financial statement, it only talks about investment carried at fair value to profit and loss, and then two more instruments that they have given. They never gave a disclosure whether category is quoted or unquoted investments, and also the market value of such investments was not given. Also, Schedule 3 was not appropriately followed in this case. We move on to the next one, IND AS 109, financial instruments, and then maybe we break for question answers again. So this is on accounting of letter of comforts or any guarantees given by the parent company to the subsidiary. So there was a note in the contingent liabilities which included values for letter of comforts given to banks, credit facilities availed by subsidiary companies, or any corporate guarantees given within the group. So disclosure was made in the contingent liability, that was right, but accounting treatment of such under IND AS was not appropriately done. So what is accounting treatment here? The accounting treatment is that you have to fair value the value of your letter of comfort or the guarantee which is given by the parent to the subsidiary company. And the fair value of such guarantee should be accounted in accordance with IND AS 109. Right? This accounting was not given or not done appropriately. Completely missed out from a measurement perspective. We pause for questions before we move on to the next standard. Do we have any questions here? I cannot see any question in the chat box or in the Q&A section. Okay, assuming no further questions there, we move on to the next one, which is IND AS 115, revenue from contract with customers. Okay, the new revenue standard. So here, company had shown interest income in the financial statement as an exceptional item. And such interest income was recognized during the reporting year and comparative year. The receivable corresponding to the same were written off as not recoverable during the reporting year. So first of all, they showed as interest income was recognized, and then they have also written it off. So again, IND AS 115 specifically talks about recovery. So if the recovery of such interest was not certain, then the first place, the revenue recognition criteria as per 115 were already not followed by the company, or they were neglected. And hence not the standard was not appropriately followed by. Again, there is a requirement under the 115 standard which talks about a reconciliation of revenue arising from contract with customers and what is the contract revenue should be given. And typically, I have given a box. You can see this. You have to. This reconciliation is generally there in the statement of profit and loss by way of a note, which talks about what is your revenue from operations and what are the adjustments and what is the revenue at a contracted price. Okay. So this is a requirement. However, the company has not given appropriate disclosures in terms of export incentives they have reduced, which is not typically adjustment. They have not given disclosures for extended warranties, if any, and they have not even made any disclosures for any other adjustments for disclosing the aggregate value of revenue from contract with customers. Also, in the accounting policies, it was stated that revenue is measured at fair value for consideration received or receivable. So this is not correct. Revenue is recorded at a transaction price. So this again disclosure was not correct. In another instance, sale of scrap was disclosed as revenue, whereas the appropriate classification of this should be other operating revenue. Okay, we're coming to the end of the course or the end of the content here. Do we have any questions here? Do we have any questions on the last couple of standards which we spoke about? No? In that case, we have few more standards which are again I have not covered in detail, but just a glimpse. That IND AS 36 impairment of assets. The company has not disclosed the appropriate discounting factor which they are used when they do the discounting workings under IND AS 36 as an example. When we talk about leases, accounting policy of the book states that lease assets are depreciated over the lease term. However, the exact useful life of the lease or the asset is not given. Under IND AS 12, they are recorded as any set off from deferred tax asset and liabilities should not be done. They're under different tax laws. This should be specifically stated that if they're netting off, then they should come from the same jurisdiction, same tax laws. Again, in one of the case, disclosure in terms of convincing evidence for recognizing DTA was not made appropriately. Again, in one place, company in the accounting policy erroneously mentioned that both DT and DTL are attributed to temporary differences and for unused tax losses. Again, few typical errors made under them. From a content perspective, this is what I have. Let's open again for questions. I have 2 questions here. And I request others also to have, if I have missed out explaining appropriately, then you can ask questions here. I can take up this one to start with. How do you do fair value of investments in a partnership firm? So if you are having investment in partnership firm, so typically if you have any investment that has to be accounted under IND AS 109 and you have to do a disclosure under IND AS 107. So any investments are categorized as level 1, level 2, level 3 investments. Okay. What are level 1, 2, 3? So level 1, 2, 3 typically is the value associated to your investment, how easily that is available. So to take a specific example, if you have a share of an actively traded company, okay, on a BSE, for example, if you have a share of a reputed BSE 30 company, that is your level 1 investment because you have the value of that investment on a daily basis, right? Those are actively traded shares. Those are level 1 investments. Very easy to find out. You can have an example of mutual funds, which are quoted in mutual funds or unquoted mutual funds, wherein if you connect with your mutual fund house or mutual fund agency, then typically you will get the value of those investments. In other words, the value is not directly available on BSE 30, for example. You have to contact with your banker and they will do their calculation in terms of where that mutual fund is invested, their money, etc. And then you get the value, NAV of that. Those are typically level 2. And level 3 are where you have to actually calculate the value of your. So fair value of your investment in a partnership firm will have to be done. This is certain proper method which is given the standard. So there are 2-3 methods which are prescribed. One is a discounted cash flow method. So you have to value the what is the business of your partnership firm and what are the assets that the partnership firm is owning. And on that basis, you have to appoint a fair valuer, or you have to appoint a registered valuer to understand what is the fair value of your investments. That will depend on the underlying assets and the business of the partnership specifically. Then there is a question on bank guarantees, very interesting, and disclosures of 109. So typically, in very nutshell and very basic explanation of bank guarantees. To take an example, parent has given a bank guarantee for loans taken by subsidiary companies, okay, without charging anything from the subsidiary company. So typically, you have to do a fair value of the bank guarantee, assuming that there is no default, but there is some commission. So assuming this bank guarantee would have been given by any third party or any bank, then they would have charged some fees. Typically, that those fees or those values have to be associated, and you have to do accounting for that under 10. Obviously, disclosures will also have to be made. And as a parent company, you have to also make a disclosure in your contingent liability that if at all subsidiary will fail, then you have to repay those. And the subsidiary will account for, obviously, if there is a loan, then that loan is already there in the balance sheet, and loan will follow through whenever you are making a consolidated cash CFS, consolidated financial statements. So that liability any which ways will come in the group. So hence there is no requirement to account for that liability, but just the fair value of that bank guarantee needs to. I hope I have answered the question. We'll pause for another 30 seconds for new questions to come in. Otherwise, I would request closing comments before we wrap up. The next question is on, can a company recognize GTA when a company is making losses for last consecutive 4 years and estimated profit for projection for next 5 years to utilize carry forward losses? So here again, this is a very big judgment. If you are having a history of consecutive losses, then very difficult to assume that next 5 years they will make profit, unless you have contrary information to support those 5-year profits. If as an auditor you have enough evidence to substantiate the profits that they will make. So for example, if they have new contracts which they have won, if they have set up a new plant which was not running appropriately, they are doing it correctly now, and you have a good evidence that next 5 years there will be profits, then you can recognize DTA. Otherwise, no. Again, judgment. How to calculate NCI if NCI is created during the year? Non-controlling interest is the value attributable to the equity shareholders of those minority people. It is calculated basis the value of NCI associated in the books. So I did not get a question. How do you calculate it? When you are doing the acquisition accounting, the residual value is your NCI, which is the proportionate share of your people who are in minority. Thus, IND AS 110 covers indirect control, like directors of company are also holding position and director in associate company. So IND AS specifically, 1110 specifically talks about if your entity is able to control. It doesn't talk about direct or indirect control. So if you are holding a board seat in that company, or if your directors or the management of those companies are accustomed to act on the behalf, then there is a control. If there is a control, then you have to do a consolidation. The next one is on errors, omissions. So if there is an error of previous year, how do you rectify it? So under IND AS, there is no concept of restatement. So there is a concept of restatement, I would say. There is no concept of reclassifications or remeasurements. So you have to determine if the error is of so magnitude that it has a restatement, that is has a material impact on the financial statement. then that error has to be accounted using a restatement of your prior financial statements under IND AS. So if you so determine that the error is so material, then you have to recast your retained earnings for the for the prior year, make a restatement, and then again don't do any accounting of that error in the current year. You have to go back last year, restate it, give a note, give a disclosure, and rectify your opening retained earnings for IND AS. Do we have any more questions before we wrap up? Or so there is a question, if there is a mistake in grouping in financial result, can we do a change in the annual financial report? So I assume you are doing a limited review. In the limited review, there is a grouping error. And when you are making a annual financial statement, then can you change it? The answer is yes, you can change it. Obviously, if there's material, then they will have an effect on your earlier reported error on the SEBI result, which you already made. But ideally, it should be avoided. While converting to IND AS, what should be the disclosure requirement of rectification of errors identified while conversion? So there's no concept of rectification of errors. If you are using a new gap and again you are any which way doing a restatement, so you restate the first day of your conversion appropriately and give a note. The question is on IND AS 110, which talks about does IND AS 110 covers upstreaming associate company? I don't understand this question in terms of what is upstream associate company. Please clarify. So 110 covers consolidation and it covers both any investments upwards as well as downwards. So, and there is an exemption if there are layers of companies, then you need not prepare CFS at all levels. You can prepare a CFS at the ultimate parent. That is a question. The next question is on if for any previous year income tax return is rectified in reference to tax notice and additional taxes paid, how this should be disclosed. So two things in your income tax return, if there are any disallowance items, for example, and taxes recovered on account of that, then you have to account for that additional tax by way of a note in terms of in your PNL, that would be an additional provision for tax. However, if your tax return is revised for adding a new income, then you have to take cognizance of that in terms of that income was then not reported in earlier year, right? So then you have to do a restatement if it's an IND AS financial statement for rectifying the income which should have been recorded last year, which is not recorded correctly here. The next question is on in case of issue of redeemable preference shares to be redeemed after 10 years at DCA valuation, how to calculate fair value of financial liability. So there's a specific method. If there are RPS and RPS is a 10-year DCF, how to calculate fair value of financial liability? You have to see if this is a compound financial instrument, then you have to differentiate between your asset and the equity portion. If it's a complex instrument, then it's advisable to go to a valuer, registered valuer, to calculate the fair value of the redeemable preference shares. The next one is on upstreaming. Upstream associate company is what is that when entity is an associate company of two entity and one of which is following IND AS, other is following IGAP. Should other company follow IND AS? Yes. If within your group there are multiple accounting practices, which is If your subsidiary company is following IGAP, that is not allowed. If the company, one of the criteria for getting converted into IND AS is that if your group is following IND AS, then you have to follow consistent accounting policies. All entities within that group should follow IND AS. For fair valuation of equity instruments, whether register value report is mandatory or practicing CA can also do valuation. Again, I go back to the auditing standard. If you are relying on the work of another expert, you have to ensure that if a CA is doing a fair valuation, is he capable of doing a fair valuation, for example? If he's a CA as well as a registered valuer, then it is allowed. Only a practicing CA certificate, I think, will not help. I think we had a lot of questions, a lot of answers. This comes to an end of the session. I think from a timing perspective, also it's 2 minutes to 7. Thank you very much.
Yeah, it was a nice interactive session, actually. Yeah, now I propose CA VL Joshi to give heartily vote of thanks to CA Harshji. And I know if full 2 hours on the webinar, it is very difficult to engage people, but you did it very fantabulously. And all the participants were very active, and they are continuously they are responding and giving the questions and answers and all these things. So hats off to you, Harsi. Now over to Viralji.
Yeah, good evening, everyone. On behalf of everyone present over here, I am glad to express my vote of thanks to everyone. A special thanks to our chief guest, C. Harsh Agarwal, for accepting the invitation and being here with us today and having such an interactive section. It was such a learning exercise. To be honest, even as a coordinator, I could not resist to raise some of the questions. That was the impact. So I heartily congratulate to you, and let us applaud the heartfelt appreciation to all those who have contributed in making this event successful. And finally, I would like to convey my gratitude to everyone here for taking time and joining this event. Thank you, everyone. Thank you.
Thanks a lot. Really eventful, lot of questions, and a lot of mixed questions. So I had to really juggle between which standard is coming through. So again, if you need further clarity, I had put down my number. You can connect anytime.
Yeah, please give your number.
Yeah, it
So
was.
are you putting in your chat box or?
Yeah, I'll put that on the chat. Yeah, I'll put that.
Yeah, please.
Perfect. Thanks, everyone.
Okay, now we can end the session.
Yeah.
Yeah,
Perfect.
Mishraji,
Thank
please
you.
end the session. Yeah. Thank you.
Thank you.